Well, good morning, folks. Hello, hello, hello. We're going to be talking about the British pound this morning and how to get more action on your first date. Just kidding. Just making sure you guys are paying attention. All right, so let's go over to the hourly chart. Okay, and what we're looking at here is the 60-minute chart of the British pound. And right away, I just want to ask you, as especially if you're a new trader, if you're new, if you have really no technical prowess or experience. When you look at something like this, it could be rather confusing. No rhyme or reason why it's doing what it's doing, and I'm gonna hopefully try to dispel that feeling that you're probably having right now. I'm leaning largely on the fact that I've mentioned these things beforehand, so I know there's some out there that really like to poke fun at me or whatever, and that's fine. You guys are welcome to do that, but you it is what it is. Okay, everything I'm going to talk about here was explained in terms of method, in terms of where the market should have gone this week. I'm actually going to refer back to how I test the market, which is a concept that I learned from George Angel when I was coming up as a trader in the 90s. My appreciation of trading the index markets like S&P 500, that became uh, a main staple in my trading, and a lot of the work that I adopted as an S&P trader came from by way of George Angel. So George Angel is like my biggest mentor in terms of what I learned specifically to trading SPOOs. Now, SPOOs is not a topic we're going to talk about at any time, but I'm saying that because he gave me an idea that at first I thought was stupid. It was ludicrous to even think this, but um, he would always start his day with a buy or a short, especially if he had an idea what the market should be doing from a technical standpoint. He would go in, for instance, say he had an underlying gut feeling, if you will, that the market should go higher. He would go short one small position, one lot, one standard or one futures contract, and see what the reaction would be as soon as he got in the marketplace. And I usually, admittedly, I try to do this at the beginning of the week. And if I'm being 100% honest with you, when I'm actively trading, I usually have about one loss per week, and it's usually on a Monday or Tuesday. And it's because I'm either testing what I think may happen, and you guys actually got the chance to see that this week, where I was in the marketplace looking for a specific thing to unfold in the British pound. And because I had, and the mentorship group knows this, I was looking for weakness on the pound. And a lot of them actually started sending me emails like, you told us to look for this thing to go lower. Why are you trying to buy it? Well, I want to make sure I have the right side of the marketplace by conviction, personal convictions. And they're usually reinforced by me feeling adversity, especially if I feel I have notes in front of me, and I'm always having my notes in front of me before I sit down in front of the charts, because I can always quickly see something on a short term because I'm multi-dimensional in terms of all time frames. I want to really be focusing on what setups are most likely to occur based on a higher time frame. So if I have that longer term or um, several days in advance perspective on where I think that market may go, I want to still sometimes go in and test it. Now, many times my analysis will be wrong. Like, for instance, if I think that the market is going lower, like I did British pound this week before the market started trading, I could be in there trying to buy it, and then it makes me money, and I'm wrong on my analysis. So it gives me the opportunity really to just move from the stance of I have to be right, or a matter of it's correct or incorrect in terms of my trading. I don't want to promote that idea because that's not how I interpret price action. I don't internalize trading success based on the definitions of being quote unquote right or wrong. It's all about whether or not my bottom line is increasing or if it's going down. And if it's going down, I have to figure out what it is I'm doing wrong. First thing is stop trading, but the main thing is I have to know what I'm doing is increasing my bottom line. That's all that matters to me. I don't care how many times I've been right in the row to get that. Everyone takes all this energy and effort in back testing and number crunching and all those types of things. And I think while in the beginning, as a new trader, if you have no idea what you're doing, absolutely it's beneficial. But to make a career of doing that, which is I think what Larry Williams, my mentor, which I love him to death, he likes that kind of stuff. It's no, he loves number crunching and all that business. But nothing changes the 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 effect on what has already happened. None of that has any basis on what you're going to do in the future because it's not going to walk forward exactly as it did in the past. That's what makes trading difficult. So what I'm going to teach you today are just a handful of things that I used for the cable trade idea, and you guys watch me do it. It was recorded the entire time from the time I entered the trade until it was collapsed. So I want you to see that the things I'm going to talk about this morning, and I'm going to try to get it done here before 10 o'clock right now. No, not 10 o'clock, 10:10. So I had a 10-minute delay in starting. So I'm trying to make it as concise and short as I possibly can. But the main takeaways is this. I want you to understand the things that I'm talking specifically about today are generic things that tend to repeat themselves. And they do not need to have a career of backtesting on them. Okay, they're just very simple principles that I've been able to ferret out of price action, and no one really likes to talk about it. Okay, because they don't know about it. So now they know about it because of the things I talk about, but you don't see it in books, you don't see it in workshops, and other people don't teach it because they haven't been exposed to it. So with your pen and pad today, I really want you to be focusing on the generic concepts and the fact that these are traits in price action that tend to repeat themselves almost on the daily, but certainly every single week. Now, that is not an invitation for you to go in and thinking, I'm going to be a rock star, I'm trading every day, and I'm going to be profitable every week. I can't promise you that. Okay, I'm going to take losses in the future. I'm going to be wrong. You're going to be wrong too. Okay, so please don't think what I'm telling you are, there is no absolutes in trading, period. But these things tend to be more true than not. And there's a lot of things that you'll learn through my tutorials, which I can't compress in a small video today, that'll help you build the criteria that you like to see in charts and then trade on that. Okay. All right. So let's get right into it. Enough of the preamble. All right. With an hourly chart with MT4, this is the reason why I like this platform. It's archaic. It's old. Okay. And I'm a dinosaur. I've been around for a long, long time. So I like that kind of thing. So some of you new cats like all these other new platforms, and I just can't make the transition. So it is what it is. If you hit control and tap Y, you get the day dividers on here. Okay. And if you have Sundays in your data, you'll see these double lines real close to one another, close proximity. This is the first one to the right that begins Monday's trading. Okay, so I'm going to define that real quick, just with a vertical line. All right, right there. Now, with that, I'm going to just add that going forward on each individual respective day because I'm going to take all the other lines off because to me personally, they're distracting. Not that it's necessary for you to be doing this. It's just I have OCD, so it has to be dealt with or it'll be very distracting for me. All right, so we have the week here divided across the days, and the first one begins Monday's trading. Now, I was looking for a reason to see if we had some momentum to push higher and take out Friday's high. I was ultimately bearish on cable, but true to form, sometimes at the beginning of the week, they can make a run and take out previous highs. Or if it's going to go lower, they'll run down and take out a previous low. Because we had such a nice response back here on the 12th of October, I was willing to side with recent momentum because this could have easily kept going higher. And that's fine. I would have been in there with something on. It was not a big position nonetheless, but I was in it. That way, if I was going to rally, if I was wrong, I had something in the race. I had something on the line, if you will. Well, it didn't provide me any profitability except for marginal gains, which you saw. It wasn't that big of a deal. Okay, I didn't suffer a loss, but from an ego standpoint, or from an analyst standpoint, or a quote unquote guru standpoint, it would feel outwardly looking in that I was wrong, so therefore I'm shamed. No, I don't feel that because I know those transitions are going to take place in analysis. So that's going to be the same thing you encounter when you do your own analysis. Don't be fearful of being wrong. If you are not willing to be wrong, you can't be flexible. And flexibility is necessary because you may see something that changes the tone on your analysis, and you have to be, well, permitting that. If you are lockstep into I have to be right from my first time and I have to stick to that come hell or high water, it's going to be problematic for you to be consistent and certainly profitable. So you have to have some measure of flexibility. And that comes by learning properly. That means going through things process based, step by step by step. Not here it all is in one video or two videos and have fun with it and good luck. It doesn't work like that. Okay. So we have our day dividers in here. Monday's trading, I was looking for a potential, try to continue going higher, take out Friday's high. Didn't give me any of that. Okay, started to consolidate. And right before this drop down, you can see I had collapsed the trade and go back and look at the video and look at all the stuff I've already shared on online, Twitter, and on the forum. So it took out these equal lows. And that said, if it took out the intraday low that was already in place, which was this one right here on Monday, go back and look on Twitter and look on my social media, you'll see it. If it does that, I'm going to switch gears and I'm going to be focusing on shorts. Now, if anyone knows anything about my concepts, okay, you already know that I teach that if it's going to be a down day, the high of the day is going to form between 2 o'clock in the morning and 4 o'clock in the morning, New York time. It's just that simple. You have about a 70% likelihood that that's going to happen if you have the daily bias right. Now, if you're new, that just whizzed right by you and went right over your head. And I'll say it again. If the bias is correct and it's going to be going down or you're going to have a down closed day, the high of the day will form 70% of the time between 2 o'clock in the morning and 4 o'clock in the morning, New York time. Trust me, it seems simple. It sounds, well, it's not a big deal. That is exactly what you're looking for. You may not know it yet, but that's exactly what you're looking for. Now, you may not be able to trade in London between 2 o'clock and 4 o'clock in the morning. You may be sleeping. You may be running a business. It is what it is. I understand that. But it also aids in knowing what the New York session is going to do. Because if you know what the London session is going to most likely do, and it unfolds as you expected, in other words, create the high of the day between 2 o'clock and 4 o'clock in the morning New York time, then chances are there's usually about an 80% likelihood that New York continues in that same direction. So that also probably went right over the top of your head as a new trader. So I'll repeat it again. If it's going to be a down day and your bias is correct and London creates the high of the day between 2 o'clock and 4 o'clock in the morning, New York time, New York generally will have a small short-term little bounce or retracement up when it's down day and then create another optimal trade entry to go short on. Usually around 10 o'clock in the morning to noon New York time, the daily low will form on down days and then it'll retrace and go into the close. Everything I just said, reverse it for when it's bullish. It's just that simple. I save a lot of time by doing it that way. It irks some people because I'm not so specific, but you're not getting specifics from me because I'm not going to do it. I'm going to demand you to do some work on your part. So we have our day dividers here. I'm going to zoom in a little bit, and we're going to walk through the individual days, and we'll see the responsiveness of price action. Monday in here, indecisive day. Now, as a new trader, I want you to cancel out Monday. That's a no trading day for you. Now, I already know some of you cats have been around here for a long time. Oh, here we go. He's saying don't trade on Monday, and I make all my money on Mondays. Fine. Wonderful. I'm going to pat you on the back right now. It's not for you. Okay, it's for the new traders. I'm teaching where the highest probability scenarios are going to be. It's on Tuesdays and Wednesdays. Simple, done, do the math, go through all your back testing on that, and you'll see they're the best trading days. Okay, if you know the directional bias. Now, if you don't use the directional bias, then your numbers, and you look back and you're going to send me email saying no, your numbers don't hold up because you don't know how to use the directional bias concepts that I've already taught. One simple approach. And the mentorship people didn't even see what I've taught you. They understand the concept of what I taught, but I didn't give that one simple little approach. And I did it just to prove that it can be done multiple ways using the understanding of liquidity. Okay, so don't discount because I just gave a couple things in video recently, and you got to spend $1,800 to come into my mentorship, which will never be offered again. You didn't miss anything there except for day by day by day, me spending hours with them. I'm not going to do that with you all. Okay, I'm going to just point in the direction of where I think price is going to go, and you should use what's already been taught to you in the recent videos, and you will do exceptionally well. Now, looking at what we have on Monday, okay, Monday is a missed day. We don't want to say anything about that day. I didn't lose anything, but I was not able to get position short, and I did not make anything going long. Okay, it was just a marginal little gain, and I'm not even going to talk about it being a profit. So the next day, we had transitioned to expecting lower prices. True to my analysis, when I shared on social media and on my forum, we will be looking for shorts. Okay, so if that's the case, we have to be doing what? Waiting for it to rally. It has to rally for us to go short. We do not sell short when price is dropping. Everyone else is going to teach you this from the retail standpoint because it feels good to do what's already in place in the chart. It's already starting to move in one direction, so therefore that's confirmation now for you. And it's not confirmation. It's an invitation to sit through retracement or be wrong. Chances of you feeling comfortable at the trade many times equates to the trade's probably 90% done. And if you do get anything on the other side of the dealing spread, in other words, if it looks profitable for you, it usually is fast and fleeting. It shows it for a second and you feel good, boom, and it takes it away from you and then runs for your stop, or just if you don't have a stop, it just crushes you. And that's where you blow your account. You have to know what you're looking for, which is the reason why I do all these hindsight examples, because unless you're knowing exactly what you're looking for, you'll never be able to identify it. You won't be able to, see that smart money footprint if you've not been exposed to many examples of it, because they're generally the same thing, just repeating themselves in subtle little deviations from the normal. Not all of them look exactly the same, but they're going to have a lot of similarities among them. All right, so we have a hourly chart, and I just laid a fib on, and I want to just kind of like get you to train your eye to look for the price swings. Now I'm giving you a range from the highest body of the candles in here. This is all I'm looking for. It's not that I'm looking for this specific candle. I get this a lot in my questions in email or send it to me by way of Twitter. When I was accepting direct messages on Twitter, people were always asking, why did you put your fib on that level? Or why did you put it on this or that? And that part looks ambiguous. It looks like it's inconsistent. It looks like I'm cherry picking. But I want you to know before we go any further what I'm doing, so that way you'll never have that problem. Or if you see someone tweeting about it in response, oh, it looks cherry picked, or he's doing this, he'll never have the balls to do that beforehand. I outlined everything you're seeing here today before the fact. I gave you specific price levels, told you how to do it yourself, what the setups look like, the times that they're going to occur. You can't get any better than that. It's better than my FX book. It's better than Trading View. It's better than doing anything, because I've already told you what the outcome's going to be days before it happens. And that's what I want to kind of like you build in your expectation with these concepts. Not in that you expect it from me, but once you learn how to use them, this is what you're able to do with it. Okay? So when I'm anchoring my fib, what I'm looking for is a high. If I'm looking for a retracement higher to sell short, I'm looking for a high that has the highest close or highest open. Now, among these highs in here, I'm using this one here because it's the highest. It's higher than this close here. And it looks like it's the same as this close. The close on this is 133.21, and the open on this candle is 133.21. So it's the same price. So I'm using that, and I'm drawing the fib down away from it. Okay, and I've already showed you how to use the Fibonacci settings with the optimal trade entry or OTE primer video. It's on my YouTube channel. You can check that out. And now what I'm doing is I'm drawing or dragging the fib down to the lowest close or open, okay, in price ranges. So we have this range here, it's nothing to talk about. I'm using this one here, and price starts to have a little bit of a retracement here, but this is where I collapsed the longs and it took another dive. Now, when the day closes on Monday, we move to the sidelines. If we took out the daily low that I mentioned earlier, that particular day, then this right here, we start looking at this candle's body. As soon as this candle opens up, we start adjusting it again. And all you're doing is looking to see until the range completes, which on Tuesday, beginning at 8 o'clock in my time, New York time, that would start the new day. That's what each one of these vertical lines is going to delineate in this particular platform. And for those that are asking, this is Forex LTD's demo account. Forex, L is in Larry, T is in Tom, and D is in drawdown. Okay, so Forex LTD. And now I'm going to draw it to the lowest body, which is going to be this candle here. Okay, right in there. Now that's the entire range I'm looking at from here to here. Now on this particular day alone doesn't do much at all. But this is the entire parent price swing from the body to the body, highest and the lowest body. Now in that parent price swing, I've mentioned this already in a few videos that we've done so far since I came back on public forum. Every price swing has subordinate, okay, price swings within it. So if this is the parent price swing, there's going to be more of a smaller fractal inside that larger one. And you see that with this price swing here. So from this high down to this low, that's another that's another price swing that's subordinate or is operating under the control of what this larger one is. This one sets the tone for the market to go lower. So inside this larger range, there's a smaller range that's going lower. So this is where we start moving our fib to more appropriate price levels. It's not ambiguous. It's not form-fitting. It's exactly what we do going forward. So we adjust the fib to the highest body, again, in all these candles in here. Put it right here. It looks like it's the highest one. Let's see what that open is. 33.05, and the open on here is 33.05 again, so it's the highest one. So from this body, highest, and this body's lowest, this is exactly what the framework would be for Fibonacci. Now, fib is not the answer. It just helps you determine where prices move to an extreme for overbought or oversold. That's it. Focusing it just specifically the three price levels, 62%, the 70.5 level, and the 79% levels, respectively. So let me zoom in a little bit here. You can see a better picture of that. Right there. Okay, so we have the range high and the range low defined with these candles. That's why folks that have not really studied my stuff, they just look at what I share, a picture, or they see something that's been shared, by way of social media. They'll look at this and say, well, this looks like it's cherry picked, and it's not. These are very specific rule-based ideas that if you stick to them, you'll see that this is exactly how the markets gyrate. They go back and forth to these levels all the time. Now, bias again was I was looking for 131.45 this week as a weekly objective. That is on my free forum at forum.theinnercircletrader.com. Everyone's allowed to get in it. I just can't approve everyone right away. This range high to this range low, that's what we're defining. We're ignoring all the wicks. Notice that. I could care less about the wicks. The books will tell you, put your fib here and right here, and then you'll be trading empowered, and you're not trading empowered doing that. So what you're going to be focusing on is the Fibonacci level, 79% tracing level, and the 62 right here. Notice it gives you specific price levels. I'm not reaching out there in space and trading supply and demand zones because I have no faith in that. And once you really study what I teach, you'll see it's beyond that light years. It's way beyond supply and demand. Supply and demand, for a beginner's understanding about support and resistance, I think it's got merit. Okay, it helps communicate that idea, but that's not what makes the markets work. Okay, believe me when I tell you, if you spend time with me, when you're done training with me, go look at supply and demand, and you'll see right away that that's nowhere near what you learned here. And again, I'm not trying to, measure up against anybody else. I'm just saying I get this a lot in response, or someone will say, "Well, yeah, he's trading a supply zone or a demand zone." It might be what would be defined as a supply and demand zone at one particular time or another, but not all the things I trade are going to have that same element. Like I cut through candles. They teach you not to do that because you have to have context in the marketplace. You have to know what the market is trying to do, and it's not based on an old or fresh supply zone or demand zone. Okay, I deal with specific price levels. Okay, there's three to choose from, so there's still a little bit of a choice in the matter, but I always go with the 62%. It makes it easy for me. I don't have to guess. I ain't got to worry about it. Okay, so if I know if I want to be selling short at 62% retracement level, okay, I'm looking at this price level right here at 133.82. Look at the price I got on that trade, 133.81. It was trading at that level at the time I put the trade on. Boom, I'm done. Did I get the other 4 pips of drawdown that I had in the trade? I could have, but I wasn't worried about it. The 70.5 level, which is a sweet spot, that's exactly where price goes. Hits it right up here, bang, nails it, goes into it, and then takes a dive. This range from here to here defines this optimal trade entry right there. The time of the day that this occurs is 4 o'clock in the morning on Tuesday. Okay, so that's what time? Between 2 o'clock and 4 o'clock in the morning, the daily high or low forms. If I'm expecting down prices, the high is going to form between 2 o'clock and 4 o'clock in the morning. Right away, you're thinking, wow, that's still, when do you do it between 2 o'clock and 4 o'clock? When two things agree. Price, which is the optimal trade entry, it's got to get into this area up here. Okay, it's got to retrace up to at least 132.82 or 132.80 is a nice round level we like to talk about in terms of an institutional sponsorship level where they go in, they put their orders around that level, or they'll reach for that level to clear out all liquidity just below it. Okay, and I'm not going to say anything more about it than that, but the point is, two things have to agree for your trade. The time element of the day, which is the kill zones I teach, between 2 o'clock and 4 o'clock in the morning, 90% of the time, all winners will have the high or low form in those specific time windows. It's only 120 minutes, okay? But in those 120 minutes, a lot of magic can happen, especially if you know what you're doing in terms of directional bias. Now, that's the time. You blend that with price, which is it's got to get to this level here. That's where the voodoo happens, okay? That's where things go crazy in your analysis, where you're dialed in and the markets will react and they respond very strongly in your directional bias, and your analysis will basically pan out in your favor, and you spend very little time below the dealing spread. You'll also notice that because price is going up, it doesn't feel good to be doing that as a new trader, because it feels like, well, what if it keeps going up? Well, it could, and that's why you use a stop. But for those individuals that have traded for a long time, you look at your losing trades or the ones that didn't perform well, I guarantee you were chasing the price. If you just would have entered when it was going the opposite direction when you were expecting it to go, that's how you win this game, because that gives you the ability, if you are wrong, it gives you the opportunity to get out many times with a scratch. And that's why it's important to be selling on up moves and buying on down moves. That's how institutional trading is done. They do not chase breakouts. They don't chase strength. They are always buying on down ticks. They have to do that. That's their models. Every large institution, they're told that they cannot execute unless price is on the downside. It's moving down before they execute on buys. Period. It's as simple as that. They cannot sell short unless price is rallying up. They got to do it on an uptick. They cannot do it. That's rule-based ideas. It's in stone. They cannot be deviated from. Now, You're going to meet about 15 different prop traders that say they do $1 million a year on social media. And they're going to say what I just said doesn't make any sense, or it ain't institutional this, it ain't institutional that. Don't believe anything I say. Test it. Don't believe me. I'm a demo pizza delivery guy. Okay, whatever you want to think of me. All I'm asking you to do is spend the time in looking at what I'm teaching you, and then you make the assumptions and decisions based on that. Don't let anybody else make the decisions for you. So here we have one example. You watched me execute in the video. Okay, I didn't give you a screen capture on TradingView and wait for the chart to be able to update later on. I specifically outlined it, and I even gave you the model of what I thought the daily range was going to look like, and we'll look at in a minute. But the reaction and the price, look how fast it moves away from there. It doesn't spend a lot of time there. Hits it and runs away. Then price starts to drop down. Then what does it do? At this daily low right here, that's 14, or basically, what's that, 9 o'clock in the morning? Sure, I got that right. That's 10 o'clock in the morning. 10 o'clock in the morning, excuse me, I have a live account that I got to make sure I'm looking at the time, because the time doesn't match up with Forex LTDs. But this is 10 o'clock in the morning on Tuesday. And between 10 o'clock and noon, New York time, the opposite end of the daily range will form. Okay, so in other words, we've seen a down day. We expected a down day. I outlined the down day. And the low of the day forms between 10 o'clock and noon, New York time. Now think about what that means for you. If you know that there's a likelihood for price to continue that long in the day, yes, take some profits along the way, like you saw me do in the video on the Tuesday's example of trading the British pound short. I have taken profits along the way because I could be wrong. It might not get down here, but you have to have something in. You have to have a hook on the the line in case you get another big run. Okay, leave something in the trade. Doesn't have to be a whole lot, but at least leave something on there. And I had a very small portion on, and I didn't get all the way down here. Okay, but I had a very small portion on reaching for my objective. My objective was a little bit higher than that. I will not look for all this range in here 90% of the time. I won't do it because I feel good about getting out where the probabilities are so high in my favor that my objectives will be met. I could care less about being Mr. Perfect. I come across as a caricature in the past, you know, given the impression that I'm getting the highest high and the lowest low of the day. I might call them by price levels within a pip or two, but I'm never, ever, ever doing that back to back. I'm never holding it from the highest high and the lowest low. It doesn't work like that. I don't have the comfort level to do that. And I've been doing it for 20 plus years. You would think it would happen, but it just doesn't. It just makes sense for me to be doing what I do, take profits along the way. Okay. And that's what I teach. It removes that mental capital, okay, increases as you go through the trade and you fund your position and take something off. Everyone else teaches you to think about what the risk to reward model was when you first started the trade, but that's a myth. It always changes. As soon as you change your stop loss and trim it down, the whole risk to reward model changes right away there. So why aren't you making an argument when you do that? Because it doesn't fit the the argument you're trying to make with other people when they show profitability. So it's all about money. Okay, it's all this game is. Price moves where the money is, and you do this to make money. There's no other reason to do it. You want to be smart, go to school, get a PhD, then come back and tell me how smart you are. But in trading, impress me with your consistency. That's all. And that's what you should be focusing on. Not being right, not getting the highest high, not getting the lowest low. So price makes that low, comes off the low, and goes into the trading right about where I had to close expected on the daily range. And I'll show you to you in a second. But notice what happens. It consolidates off the low, consolidates. So the daily range is this. It opens here. It opens, trades up, makes the high of the day, London between 2 o'clock and 4 o'clock in the morning, and makes the low at 10 o'clock in the morning. Specific times. That's like Swiss clockwork. It's perfect. You can't get any better than that. Okay? Then it trades off the low into the close. Now, where this thing closes, let's take a look at it. I think it's this one here. Nope. That one. There you go. This is what I had on the chart, and I had a guy email me, said that I added this on my recording. It did not. You can see that you can move it around. Okay, so all I did was where the opening was, I put it right there. And I expected the price to move right from the opening up, excuse me, 33 pips. I teach and I have taught that when the days are going to be bearish, from the opening price at midnight, get that opening price. If you're shorting, add 30 pips or specifically 33 pips to that opening price up. That's what this blue line or blue shaded area is. Okay, this whole rally, or not rally, but this range in price is power of 3. And then there's a lot of things on this chart, but the all this is highlighting. Let me get this off. This is highlighting just 33 pips right there. Okay, so price from the opening price, it does what? It rallies up. Well, let's see what the opening price is. We'll just call it 32.57, and the high. Zoom in. 32.87, 30 pips. Bingo. Now, I said this to somebody on social media days before it happened, and it's one of my critics. Okay, and I said, in fairness, I'm going to show you something, and I promise you, you'll learn something from it. I didn't make this example because it worked out. If you go through my tutorials, and there's thousands of you, tens of thousands of you that have done this, you've gone through my stuff. I taught that 30 pips from the opening price above it, that's where the algorithm that runs price, and that's what really goes on, folks. It's not what you think it is. The price will expand up 30 pips. That's where the market will create the high. Now, what did I just teach you? It's going to happen on down days between 2 o'clock and 4 o'clock in the morning, New York time. It's going to what price level, Michael? Well, about 30 pips above the opening price. That's the range it operates in. But you have to get a measurement on how far it could go to really become like an overbought condition. I am not plotting stochastic or RSI on my chart to get overbought or oversold. I'm using the basis of understanding the recent price range, because that's what really your indicators are doing. They're looking back a certain number of bars and calculating that range, high and low, and factoring where price is right now in relationship to that range to determine whether it's overbought or oversold. I don't need that stuff. I can look at price action, and I teach my students to do the same thing. If I can see where the recent high is that we're working in, well, this is the most recent price action in here. We had a nice little drop down. Okay, so there's an impulse leg that we can work with here, and we can draw fibs on that to get a rough idea where it should go. Then we also had the higher time frame hourly chart, which had that fib on it right here. We knew that 33, or at least I'm showing you now how I did it, 33.80 is an institutional price level. I taught you that in the recent videos on YouTube. Those levels are like magnets, and they also act like magnets when you try to put, well, let's see, opposites attract. So when you put the same polarity of magnet together, what happens? It repels. Well, that same effect happens here. That's what they're like magnets. Okay, they can draw price up to it, but then when everything agrees, the poles become the same. They repel price. It pushes it away. So if we go back to this example, this blue shaded area is exactly 33 pips from the opening price. I challenge the people that have not gone through my work to do this on a daily basis. Study how much price moves away from the opening price at midnight, how much it does this, how many pips up or below it, and keep a running total of that for about 2 months. And you're going to see on the best trading days, and I'm not teaching you how to get the best trading days by doing this example. This study point just is going to highlight when the things are in line for price to move in a specific direction. When that occurs, these things occur 90% of the time. Time of day, 2 o'clock to 4 o'clock in the morning, New York time. What price? Up to a fib level and inside this range. Now, what does that mean? The fib could line up with something that right in here, and it doesn't go all the way up to 33 pips or 30 pips. It may go up just like 20 or 15 pips. But if it overlaps with an area that would be like a fib, and it's between 2 o'clock and 4 o'clock in the morning, and it's bearish, that in itself is enough to make the high of the day. Now, what happens if you didn't execute and you just couldn't get in there to execute on that? No problem. When price gets down to the opening price, okay, you can sell short any rally away from that opening price. As price moves away, like this candle right here, let me zoom in. this candle right here, when price hit it, okay, and moved away from it in here, that movement in price, any movement away from that opening price, as long as it's above it or at it, you can sell short using my rules. If you trade below the opening price, you have to wait for a retest. You get it here. You only get many times, not even this retest, but if it does, and you're right on your bias, and you're not going to know that until the trade's done, but if you feel convicted about it, like I'm trying to prevent that idea of thinking, you're going to be able to sell short there, and your stop has to be above the high of the day. It has to be above it, okay? Don't get fancy in here and try to say, okay, well, here's a high, here's a low, and I'll use a 79% tracing level, and I'll put a stop above that. Don't do that. Your stop's got to go all the way above the daily high, okay? Now, what happens if you can't be up at London and you still think this is a good idea? Well, what you can do is you can put a sell stop in place. You wake up at midnight, New York time, and wait around till about 12:30, or set your alarm for like 1 o'clock in the morning, even better. 1 o'clock in the morning, if we're above the opening price, put a sell stop right at the opening price, less 1 tick or 1 pip, and then use a 30 pip stop loss. You won't know what the high is, okay, but what will happen is usually the high will form and it goes back down below the opening price. Autopilot. Nothing needs to be done except for place the sell stop in there. Now, sell stop, many times you're going to be thinking as a new trader, that's protecting your long position. Yes, but you can also use it to enter a short. So if there's no other orders in and you place a sell stop in there, price trades down to it, it executes you short. Now you're short, net short basically, and you have to use a protective buy stop in that. So you have what? You're trading London on autopilot. You're not getting all this better fill, but who cares? Because you have a life to work within. You're running a business. You have a marriage you got to keep. Okay. You have things you got to do. You can't do it. Okay. Well, that's give you a reason now that you can do it. There's no excuse. There's no excuses for you not to participate with the things I teach. But my personal opinion, it's worth losing sleep to watch this stuff unfold because it teaches you so much about price action. Okay. So now there's the model I used for the closing price right there. And I'm going to put that here. Okay, I'm just going to rough it right about there. That's where I had the closing price. When we walk forward, let me see if I got the day dividers in here. I'm not sure if I have one. Yeah, there's the horizontal line. Look where the price closes on that day and starts a new day, right where I had it outlined. Now, was I right about all this range down here? No. I wasn't right about that, but I was right about the day. I was right about the bias. I was right about my entry, and that's enough. I don't have to be perfect. And my weakness, I've already been very public and candid about this. My weakness in my trading is my exits. I've always been trying to find ways to improve that. And every time I think I got it, I just go back to what I'm comfortable with, what you see me do. I scale out at logical positions, and I always exit before I think where it's going to ultimately go. And that's just it. And I think it's ingrained in me from Larry Williams because that's his exit strategy too. You know, as long as it's in his favor, it's like bailout. It's my version of his bailout. And bailout's the first profitable opening, in case you were wondering what that was. So let's go back over to this hourly chart, and we'll wrap this video up because we're going a little bit long-winded. So price has that big move, and I told you I was going to sit on the sidelines. Okay, and on the next day we have a little bit of a consolidation day. But the main thing I want you to look at is how price each day takes out the previous day's low. Does it here? Here's this day's here, and we take it out here, and then we have a nice little retracement. But what is it retracing up to? What did it do here? Is there anything significant about this? I mean, we have a rally up here. If we go and use a fib on this, we have the highest body all the way down to the lowest body right in here. We have the lowest body and the highest body. Does it give us an optimal trade entry in here? No. Did you need this last trade? No, you didn't need that. This day here could have been a losing day, could have been a profitable day, depending upon what you did with it. Is it bad that you missed anything? No. Is it bad that you missed this trade based on an optimal trade entry not being there based on this particular time frame? No, you didn't miss anything. But if you know that there's a likelihood for price to have gone just a back above this high here for a false breakout or run stops out for those that are trailing stop loss orders tight. In other words, they say they sold short up here, and now their stop would be here. It went right to that level and then starts to drop down. So we're going to look at this little area right in here, and you can see we ran out yesterday's low with this move here. But ultimately, I said 131.45 was the level I was looking for the week. 131.45 is right there. We went down just below it by a little bit, and look at the reaction off of that. This movement right here. Now, I'm not going to go into why I believe 131.45 was a good level here. Just know that it was before the old low. And again, that's enough. This is the old low back here. It may not go down below that low, but if it gets back down in this area, that's good enough for me. And that's all I looked for. I looked for 131.45 because it's one little 5 level below the 50 level, 31.50, and it just makes sense for me to reach for that level. And it's as simple as that. Try not to read more into it. You don't need to have every answer. Just know that that's a good level to reach for. An old low, but it may not have to go through it. Okay, and that's enough of a range from here down to there. And you watched it unfold. I gave it to you in detail. I told you how to trade the setups each day, but I want to look at this little portion price action right there and give you something to think about when we close. And I know this is a little bit of a longer video, but I didn't get a chance to talk to you guys yesterday, and I didn't have any videos up. But inside this little block of price action in here, okay, let's do this. That is the beginning of the day. So we're going to go to 4 o'clock in the morning on this platform is midnight New York time, by the way. So if you ever see 4 on Forex Ltd in my videos, that's delineating midnight New York. Okay, so let's zoom in a little bit in here. And we have the opening price right there. So opening price comes in at 32.12. So 32.12 we have price opening up at, and the end of actual high ends up going to be 32.25. So 32.25, excuse me, is the highest point it reaches post midnight New York time. Creates the high. I'm going to say there's nothing up here to give us a reason to justify a move there. No problem. Price does what? It breaks down. It does what? Yeah, it breaks down. Below what? The opening price at midnight. So we're going to draw a horizontal line on there. Okay, and again, what was the theme for this week? Expect 31.45. Expect lower prices on cable. Okay, fine. That means any rally, we want to look for suspect price action. In other words, it's going up to go down. So the opening price is here. Use that same idea I told you earlier. If you can't be up to trade this live, and there may or may not, I'm not going to tell you anything. Mentorship would see this stuff, but you may not. Say you don't see anything in here to justify selling short here. Great, no problem. What's the rule say? It's got to go back to the opening price. Okay, you can be a seller still. If you do a sell stop below the opening price, that's just as well as it's doing any other trade. Now, look what's going on inside this little area price post midnight time, right in here. Look closely before I draw anything on the chart. I want you to see it like that. Fib, highest open or close, right here, down to the lowest body, open or close. We're going to zoom in right there. I already hear the trolls. Oh, here he goes, doing the hindsight stuff. It's the same rules, okay? It's the same stuff. You're going to do this every single trading day in your own charts, okay? So let me put that vertical line back on because I had to get that box off. And it was right where I needed to be at. And scrub this over here. Right there is midnight. So we have a rally up, and this really should be right there on that opening price of that candle. This candle right here is opening. That's the opening price at midnight. So anything above it, you want to sell it. And if it trades back to it, right here, it's acting as resistance and optimal trade entry right in here, right there. Okay. There's your sell off. And finally reaches for what target? 131.45. And then ultimately does what? It bounces. Look where it's at now. Personally, gun to my head, because I'm sure everybody wants to know this. What's it going to do right now, ICT? What's it going to do right now? I don't care what's already happened. Tell me what's going to happen right now. I don't know. I don't know what's going to do. Why? Why am I feeling comfortable telling you I don't know? Is it because I'm ducking and weaving? No. Because it's already hit my objective. I don't know what it's going to do now. Can it go lower? Sure, it could. Do I want to trade it again now? No, because it's already hit my objective. So there has to be a battery life that's definable in terms of, like, this is what it begins and this is where it ends. There's a life cycle to your trade. And mine has been expired. It hit my objective. So I don't have another opinion yet. When new technicals shape up and provide me reasons to frame one, I'll share it. But for now, it this is my one shot, one kill. This is what I look for every single week. Did I get the absolute low of the week? Well, the low comes in this platform. I'm not sure what your low was, but and in fact, if you wouldn't mind, on Twitter at my Twitter handle at I_am_ICT, if you would tweet your lowest low today on GbpUsd, I'd appreciate it. That way everybody can get a feel for how much of a disparity it is across all different platforms, live and demo. But the low comes in at 131.37. Okay, so I'm off by 8 pips on the weekly low. I was off by 4 pips near the highest high of the day entering short. Now, to me, that's pretty friggin' precise. I mean, that's really precise. You couldn't have convinced me when I first started that you can get within 50 pips of the daily high and low 2 times a year, because I was taught price is random. And this is the last thing I'm going to say and close of today's session. There's absolutely nothing random about price action. There's zero randomness to price action. Today, I've given you very clear hallmark examples that are generic characteristics that repeat themselves every single day and every single week. Week in and week out, day in and day out, ICT stuff is always there. Now, am I going to participate in every setup? Absolutely not. Am I going to show you examples that I did not participate in? I did today. But you watched me do something that I outlined before the fact, and anyone that says I have to do this or do that, I'm not answering to those individuals. I don't have to do this. I don't have to do any of these things. I do it because I enjoy it. I'm not going to jump through hoops for anyone, but I want you to know this and write this in big, bold letters in your notebook and underline it, highlight it, date it, sign your name next to it. Price action is not random. It's manipulated. And until next time, I wish you good luck and good trading.